But if you cracks carbonate gone 10x drop within the last 5 years, so peaking up, getting to almost $100,000, going down as low as 8,000 at different points. That's a tremendous swing that when you're building out your business cases, when you're figuring out whether or not a project is worth investing in, if you're not planning for both of those scenarios and have a strategy to manage your risk, regardless of where the price ends up being, that leaves you with major exposure. And of course, this isn't unique to lithium. We've seen similar in the nickel and cobalt markets as well. Not as drastic of swings, but still a 250% swing, over 300% swing. These are similarly going to very quickly deteriorate a business case that often has relatively thin margins to start with. And there's a few main reasons. We don't believe that these structural drivers of volatility are going to go away in the near future. For one, battery chemistry is still evolving. As further enhancements come to batteries, it's hard to say which direction exactly the demand for these materials is going to go. Second is that EV demand cycles drive major swings here. Of course, I'm calling in from the US, where EV demand is relatively cooler than it was a year or two ago. But you look at the rest of the world and you'll see that we're in a unique environment compared to where so much of the world has this strong demand for EVs. And that's going to only increase the need for more and more batteries. And supply for some of these materials especially remains very geographically concentrated and sensitive to policy swings. You don't want the fate of your business to depend on what a government on the other side of the world is going to do that might impact supply. So starting with a brief look at lithium itself, here's an example of that major swing that we've seen these last 2 years. So of course we talked about peaking at around $80,000 going down to 8, but even if we look at where lithium is trading at the start of this year, north of $25,000, it was only this time last year when it was sub 10,000. That's a major difference. If you looked at a project that was starting to build out the financials last year compared to today, it can really jeopardize things. And when we look at some of the recent moves, we see things like the 2022 peaks as the battery grade carbonate started to have the demand overrun the supply for what was available at that time. We also saw in 23 to 25, supply caught up quickly because it was clear that the demand was growing so fast. And so companies that built up supply really started to try and offload that and capture some of the market while the prices were hot. And then, of course, now we see things with supply delays. We've seen some of the policy changes, places like Zimbabwe, that are drastically driving those prices back up and doing it quickly. We'll briefly talk through nickel and cobalt as well, where we see similar, but here when we take a look at some of the recent moves, again, it's government-backed and finance capacity that's all of a sudden creating a surplus in the market. If we look at Indonesia, as far as the EV demand goes, as demand has cooled off a bit, that's going to decrease some of the upward pressure on pricing. And getting to where we are today, the LME is expecting a decent-sized surplus for this year, which is not going to help maintain these high prices for too much longer. In cobalt, this is a great example of one that is very, very heavily dictated by what's going on in policy in one country especially. So we can really tie each of these jumps in levels of cobalt prices to what's going on in the DRC, with around 75% of global supply coming from the one country itself. We saw only a few years ago prices fell to drastic lows as some of the large trading firms like a Glencore started to add in supply to the market. But then as soon as this export ban went into effect in the DRC, prices started to jump very, very quickly. Uh, and on the flip side, with nickel, fast markets is actually expecting a deficit through next year. So only indicating that prices may go further higher. And so we've talked a bit in the abstract about what happens to a deal, what happens to a project when you price it out at a certain price level and assume it'll stay there versus once it starts to move up quickly. I just wanted to ground that in some real numbers for you here. So for example, let's look at this 100-ton nickel trade. Say you expect to make $500 a ton on this, and when you initially buy it, you're expecting that nickel will stay at LME price of around 17,000, where it was trading not that long ago. If you say you'll hold it for a week and make that $500 a ton, you're going to make $50,000 on this trade, which is pretty good. But that $500 margin only exists if you're actually seeing the market stay flat, if you're not hedging. So here in this base case, that's the LME doesn't move. It's been a very, very quiet week. Nothing happened in the world. And the cash price on the day you buy, cash price on the day that you sell are exactly the same. As much as we would love that kind of world to exist, that's not reality. Recently, what we've seen, LME can swing as much as 5 to 10% within a week. And so when we look at that 5% move, for example, in this case, that would be an $850 per ton swing. And all of a sudden, your trade that was a profitable 50,000 is going to lose $35,000 for you. And that's assuming that it only swings 5% that week. We've seen in recent weeks, LME will move 10% in a week in the nickel market. If all of a sudden it goes to a 10% swing, you will lose $120,000 on this trade. All this to say, it's well within possibility when you're exposed to these kind of very volatile physical commodities that when you're building out projections, it's hard to really capture the full impact of the volatility because of how big some of these swings can be. And because of that, it becomes all the more necessary to actually hedge and have a strong risk management strategy and process in place. For decades, if you wanted to hedge lithium or cobalt, you didn't really have an option. Back looking before COVID, pre-2020, if you wanted to trade either lithium or cobalt, the futures market didn't really exist. Nickel existed, but had very limited adoption. And so if you wanted to have a project in this area, if you were exposed to these commodities, you didn't have much you could do with risk besides hoping that the market would play nice for your trade duration. Today, 2026, we see that there have been contracts popping up across exchanges around the world. So we'll see, of course, nickel and LME is still going strong. Cobalt has a CME contract that's been around for 6 years now. And some of the lithium contracts are starting to trade on the CME as well. I'm not going to tell you that the liquidity is perfect. It's not like copper or aluminum, which are going to have tremendous volume and it's very readily available. But the liquidity is growing fast. And these are areas where both exchanges are very keen to dive into and capture. Plus, there are companies out there that can help you hedge these materials. Today, if we wanted to look at where liquidity really sits across these commodities, we can see for lithium, it's growing fast across CME and GFEX. Of course, it's can be difficult depending on where you are to actually get access to some of these exchanges. Same with nickel trading on LME and Shiffy, and with cobalt. But the instruments do exist. It's a matter of getting access to them and using them correctly at this point, not that the tools you can use to manage your risk don't exist at all. So you have options. And when I talk about exchange access, having access to an exchange and a contract is not the same thing as having an easy route to starting to hedge. In the past, many physical operators have looked at hedging and said it's too difficult, it's too complicated, and in practice, it just added a whole new set of requirements, challenges to the organization that they deemed too difficult and they walked away. Things like minimum clip sizes, where you're going to need to trade a standard contract if you go direct to the exchange and through a traditional broker, makes it so that if you're trading smaller increments or if you want to just do a subset of your business, it's very difficult. Costs can also be not always the most transparent. You'll see different costs going on with brokerage fees, clearing costs, margin financing. We know that the traders out there, the producers out there, already have relatively thin profit margins, and we don't want this to become another black box that sits in your financial statements that is hard to predict and hard to know where it's going to go. Setup complexity can take ages and a lot of pulling out your hair to try and figure out what's the best way to do it. And operationally, once you've got all that set up, actually dealing with margin management, mark to market accounting, making sure you have a full, clear picture of how your positions are doing, it takes a lot of effort historically when you're using a series of gigantic Excel spreadsheets trying to reconcile your physical trades with your hedges and your derivative purchases. There was never a clean or easy way to really make those match until today. So, what Pillar does, we've designed a hedging platform for physical operators like you. The exchange has built the products. What Pillar has done is we removed the operational friction and those onboarding frictions that made it difficult for physical operators to actually use those futures products. So, unique things with a company like ours, any size, any deal, we will help you hedge to the exact ton. So you don't have to worry about standard lot sizes and figuring out what's the best way that you're going to fit your business uh, into these clips. It would be like trying to put a square peg into a round hole. It doesn't always work. When you look at fast setup, we can get you onboarded very, very quickly. We've worked with companies from around the world at this point, um, and can make that quite seamless. Can also just the lower cost and transparency working with someone like us, where it's a very clear upfront price, and I'm happy to kind of discuss further offline with anyone who's interested in our pricing structure, and the simplicity of we've built out the platform so that it speaks the language of your business. So we know that you have a million things going on in your head running a lithium business today. We don't need to add um, becoming a financial derivatives expert to that list for you. We will help you take care of that so that in the long run, you can make sure that your business has access to these tools that the big companies have had access to for a long time. Uh, Ultimately, in the long run, hedging isn't a choice. It's really going to be a core part of how a physical business operates. The markets have gotten too volatile to the point that leaving yourself unhedged, fully exposed, it just creates a lot of risk. Um, and so what we've tried to do is say Pillar makes it as easy as it should have been all along to actually start hedging. Now, we've talked through a lot. If anything, I want you to walk away with three things from this presentation today. Well, first is that the volatility in battery metals is structural. It's easy to look at historical price charts and say, this is just a recent fad. But when we look at the things that are driving that volatility in prices, those aren't factors that are temporary, that are going to go away next year. If we just say we're going to ignore it for now, it'll be okay. This volatility is here to stay. Hedging for a long time was impossible in the lithium market, in the cobalt market, but it's not anymore. So the infrastructure to help manage your risk is there in a way that if you said 10 years ago, I really want to start hedging, it would have been very, very difficult. So at this point, the remaining barriers are operational, not market based. If you take away from this that it's time to start hedging, you want to figure out how to manage your risk, there are companies out there like Pillar who can help you get that hedging operation stood up because it's just a matter of time, effort, prioritization at this point, which we try to minimize anyway for you. It's not a matter of saying that there's nothing out there to help you. So thank you. And as we always say at Pillar, you can't control the market, but you can control your margins. Obrigado.
Yes,
To see you all next year.